All right, look at that. My design team really knows how to get their message across, right? 8.5% in a country where average inflation has been under 2%. I filled gas in my car yesterday, and a $100 bill didn't fill up my 16-gallon tank. Section 1 of this presentation talks about runaway inflation, interest rates, and the Fed's dangerous gambit. So get ready for some powerful data. Now, let's start this journey by looking at mortgage rates first. Let's start with this CNBC video from about 2 weeks ago. Now, before I play the video, remember, the Federal Reserve doesn't set mortgage rates. They only influence them.
Hey, Morgan. Yeah, rates took a sizable jump higher at the end of last week, basically adding insult to injury in the heart of the spring market. The average on the 30-year fixed hit 5.64% on Friday. That's just over 2.5 full percentage points higher than a year ago, as in we were in the very low 3% range last year. Mortgage rates loosely follow the yield on the 10-year Treasury, which spiked to over 3%. But rates are also taking a hit from the Fed unloading its balance sheet of mortgage-backed bonds. It was the Fed's increased purchasing of those bonds during the first 2 years of the pandemic that kept rates hitting more than a dozen record low. And those low rates fueled the crazy high home prices that we now have this spring. Home prices are 34% higher than the start of the pandemic, and they just keep moving up due to high demand and still low supply. So if the 30-year fixed hits 5.75%, which it very well could this week, that'll mean the monthly mortgage payment for the average home is $1,867 higher than it was at the start of the pandemic, $1,867. That's if you're putting 20% down. It would be over $2,000 more a month if you can only put 10% down, which is a lot of first-time buyers using FHA mortgages, and they, of course, have the least wiggle room in their wallets. We're now seeing sales fall and reports anecdotally that bidding wars are starting to cool off. Prices usually lag sales by about 6 months, so this summer should be pretty telling on home prices, Morgan.
So let's quickly summarize that video, right? There's a lot in there. Mortgage rates in May are up to about 5.64% for 30-year fixed. And last week, by the way, they dropped a little bit, but still almost at 5.5%. This means that they're more than 2.5% higher than 1 year ago. And we also saw that home prices are 34% higher than before the start of the pandemic. And this means that the average monthly payment is over $1,800 a month higher than at the start of the pandemic. Are you kidding me? $1,800 a month? That's $22,000 a year. What regular Joe American got a $22,000 raise in 2 years? Nobody. So that's the good news. But I want to point out that the media loves to pick up the highest number to get more eyeballs. That 5.64% number is not representative of the people that are watching this webinar right now. So I sent my team out to shop rates on the internet. This is about 2 weeks ago, right? And I know my investors can put 20% down. You know, you guys have strong credit scores when you're buying single family homes. So while 5.64% may be the average mortgage rate, note that that buyers that have higher credit scores and higher payments than a typical buyer, so you see these up here, right, will get significantly lower rates. So this data is from bankrate.com. As you can see, the rates that are shown in this gray shaded section are actually in the 4.5 to 4.75 range for those with 20% down and 740 credit. Now, these numbers are for primary homes, not for investment homes. But what this means is that people with lower down payments and lower credit scores, basically the first-time buyer, are actually going to hurt a lot more than richer investors with more buying power who are still getting rates well under 5%. Bad news for the common man, less bad news for the affluent investors. You'll never hear, TV channels say stuff like that. So if you put 20% or 25% payment, you'll get a better deal. But still, it's clear that mortgage rates are skyrocketing, right? I mean, 2.5% increase in 6 months is a stunning increase. So let's spend a few minutes to understand why rates are skyrocketing. Well, in short, they're going up because the Federal Reserve has announced that they're going to fight inflation by raising the Fed funds rate. Let's look at where inflation is at the end of April, 8.3%. And as you can see, from the red line, this red line in this graph, inflation in the US tends to average just a little bit under 2%. And the Fed's job, the Federal Reserve's job, is to keep it at that number. 2% inflation allows the US to keep overspending and running up deficits Because inflation, it's a hidden tax. It reduces the value of money. So inflation is good for spenders, bad for savers. However, high inflation is good for absolutely nobody. It's bad for consumers, it's bad for businesses, bad for retirees, even bad for real estate eventually. And as you can see from the chart above, inflation is far, far above the 2% line. Now, it's wrong to look at inflation statistics without acknowledging that the official measure of inflation, the Consumer Price Index or CPI, it's inherently flawed, people. The numbers may be cooked, right? The CPI is used to adjust Social Security payments for retirees, and there have been accusations for decades that the CPI is manipulated to show inflation to be lower than it is. So it's also useful to look at an unofficial index called shadow stats, which might show a more complete picture. As you can see from the blue line above, real inflation could be as high as 12%, while the official line in red is around 8%. So bottom line, inflation is truly, truly extremely high, and the Federal Reserve has no choice but to take aggressive action to reduce inflation. Let me say this again. The Fed has no choice. Now, the Fed can control inflation by raising and lowering an internal rate called the Fed funds rate. This rate, which is a rate that banks charge each other for the excess reserves, it has a direct impact on mortgage rates, though mortgage rates can be often out of sync with the Fed fund rates for many, many months. In general, the Federal Reserve raises rates when inflation is high and the economy is overheating, and then drops them when the economy is weak. Right? For example, if you look carefully at the chart, you'll see that the Fed raised interest rates 9 times between 2015 and 2018. And by doing that, it slowed the economy, cooled it down, and was then forced to back off and drop the rate 3 times in 2019. What I'm pointing out is that this rate raising business, it's more art than science. The Fed raises rates, then waits for a while, studies the economy, then drops them, waits for a while, rinse, repeat. It basically plays Russian roulette with the US economy. And as you can see from this comment in The Guardian, the Fed is now expected to raise rates a total of 7 times this year. Now, they're already done with 2 hikes. So 5 more hikes coming, which should take the Fed funds rate from 0.25 when they started earlier this year to about this, 2.9%. And what is the Fed's goal? To engineer a soft landing. Soft landing. So more about that in a few slides. Okay. So the Fed has hiked twice so far this year, a total of 0.75%. But you just heard from the CNBC commentator that mortgage rates are up by over 2%. So that's weird. Aren't these 2 rates tied to each other? Yes, but very, very loosely. What's happening is the market is anticipating what the Fed will do and has raised their rates by 2.5%. Well, this number's wrong here. It should say 2.6%, not 1.6. So basically, these dudes, they're running almost 7 or 8 hikes ahead of the Fed. This is very important to understand. The market's already up 2.5% from the bottom, and the Fed's only up 0.75%. So the Fed actually has to catch up to the mortgage market. Yes, but Neal, what happens when the Fed hits the 2.9% level that economist was talking about a few slides ago? Well, here's the answer. This is so important. Listen carefully. The answer is when the Fed reaches that level, they will start cutting rates. Yes, cutting rates. Look at this chart, right? The Fed controls inflation literally by gut punching the US economy. They taser us, right? And the country can't take the shock of these high interest rates for more than a few months. Look at this chart, and you'll see across the chart 9 hiking cycles. All these 9 peaks on the screen are extremely short. In fact, these peaks don't even last more than a few months, given how addicted the economy is to financial cocaine, that's ultra low rates, and financial meth, that's ultra low liquidity. Why would you expect this time to be any different? The patient, us, the US economy, is going to die if it doesn't go back on the drug drip. The Fed knows that. The rates are likely to peak by the end of this year or the beginning of next year, and then inflation will hopefully moderate to, let's say, 3 or 3.5%. And then rates will fall, just like they have 9 times out of 9 in the last 61 years, because the Fed is simply trying to engineer a soft landing. And as you can see from the Investopedia definition, a soft landing is the Fed's goal to slow the economy down without it going into a severe downturn or a recession. choke the air from the lungs so the patient stops running around, and then resuscitate the patient before he dies. This highly technical diagram on the left accurately describes what the Fed is now doing. So, of course, a data-driven audience like this wants to know, Neal, how often has the Fed really soft landed the plane? Well, as you can see from this quote on the left, this is from Politico, the Fed sucks, absolutely sucks at creating soft landings. In the last 61 years, the Fed has tried to engineer soft landings a total of 9 times. Now, how many times did it succeed? Once, one time in 1994. Not the best track record. Why? Well, that's because it takes many, many months for interest rate hikes to actually affect and slow the economy. So the Fed has to make educated guesses about the impact. In other words, the Fed cannot aim, fire, measure. It's more like aim, fire half a dozen times, then measure once. So here's another highly technical document that very accurately describes what the Fed tries to do when it hikes rates. My team, by the way, loves these cartoons. Clearly, they're getting very carried away by this stuff, Anna. All right, so that technical document explains the problem, and it explains why the stock market is slowing down, crashing, goes up, went up this week, but last week it was gloom and doom. Investors, they feel that the Fed's job is much harder this time than most of those last 9 times because inflation is so severe this time. And so they have very, very little trust in the Fed's ability to prevent a recession. And the market, it's really addicted to ultra low interest rates and this high liquidity punch bowl. And the Fed's taken that punch bowl away. By the way, in case you're wondering, REITs or real estate investment trusts also down about the same as the S&P 500, about 18%. Okay, so the Fed doesn't have a great track record. Wall Street doesn't trust the Fed. But to be fair to the Fed, they might have a pretty decent chance of actually achieving a soft landing this time, because this Fed has one unique weapon. The Fed is tightening in an economy that is drowning in money, in cash. Americans have absolutely fantastic household savings. As you can see from this graphic above, the total value on the left here of America's savings, and this is both savings and money market accounts, this was about 12 trillion 10 years ago, so in 2011. Today, that $12 trillion number is sitting pretty at over 22 trillion. In fact, a staggering 5.8 trillion has been added to savings account just in the last 2 years. That was all that helicopter money that the government sent out, right? So this is incredibly good news for the Fed, because this $6 trillion buffer means that consumers are continuing to spend even as inflation goes up. They have a lot of money. And this gives the Fed a better chance of engineering that soft landing. Ta-da! Household balance sheets to the rescue. All right. Now that I've finished my Fed bashing, I do want to point something out. 5.5% may seem very high, very high. Please note, though, that people were buying homes at 18% interest rates in 1982. Look at this graph. And you see, I'm going to move the mouse. You see this gray area here, 1982, right? As you can imagine, this gray area is a recession. So it was caused by this peak, right? The Fed raised interest rates to 18, and they immediately caused a recession, right? They were trying to kill inflation. Now, I wonder what happened to home prices when the Fed raised interest rates to 18%. Now, just to compare, we are predicting that the Fed funds rate will go up to less than 3% at peak. This is 18, right? So you might think that home prices would have crashed and burned, right? I mean, who would be stupid enough to buy a home with 18% interest, right? Wrong. When the Fed went to 18%, home prices went down by 10% the next quarter, bounced back by 10% the following quarter, and actually ended up higher at the end of the recession than at the beginning. Americans, we love buying homes. We're not easily deterred. And that was one example. Let's take a look at another example on this page. So, between 2001 and 2007, rates stayed between 5 and 7.5%, and we still had a strong housing economy. So while 5.5% today seems high, it's really nothing special at all. I also like to show this graph to you guys. Like, this isn't updated to 2022, but what I want to point out is that mortgage rate trend in the US declined for 150 years. Then they went upwards until they peaked in 1981. And since then, for 4 decades, they've been moving in a downward trend. And when this short-term mortgage rate spikes ends, and should end fairly quickly, I don't expect that downward trend to change. Why? Because it's all tied back to macroeconomics and increasing world debt, which, by the way, is covered in my How Banking Changed the World webinar, which is available on our website, multifamilyu.com. So if you want, maybe Anna if you can find a direct link and stick that in chat for those that basically want to understand why the heck it is that interest rates only go down in the long run. All right, done with section 1. Let's summarize. Rates are high because the Fed's battling inflation. Data indicates that mortgage rates will peak around the end of the year, as mortgage rates actually anticipate future Fed increases, so they're ahead of the Fed. And while we all hope that the Fed engineers a soft landing, history shows that's going to be unlikely to happen. All right,